Alright, so today's lesson is about being an adult. Thinking about credit cards, we're looking at housing and cars, and then also good things and bad things that can occur using these. So credit card advantages, obviously it's the concept of buy now, pay later. You can enjoy goods and services without needing cash. It's very flexible. You can purchase things online. It's handy in emergencies. And you pay bill in full by due date to avoid interest charges. And usually there's a 25 or 30-day grace period. So if you pay off your bill in full, then you won't owe the company anything. And often another advantage is that credit cards have some kind of reward or point system, whether it's airline miles, whether it's cash back, or other benefits as well. Now the disadvantages are some of them are subject to credit qualification. So if you have a low credit score, you may not qualify for a credit card. Also, some have annual or yearly fees. For example, you may pay $75 to have a credit card, but there's often ones that don't cost any money. And then there's also terms, rates, and fees that are changeable and that you need to keep on top of. Also, there's different interest rates, and they will vary. Usually they're between 10 and 25%. So if you only pay your minimum amount, which we'll look at in a minute, your interest rate, you'll be paying a lot on interests, and it will start adding up over time. So it's important to manage your money and not spend more than you have, and to be able to pay off your credit card statements. So we're going to look at an example here. Stacy Casey. Okay, this is what a statement would look like online. Okay, it's a statement. It tells you the date of the statement. It tells you her current balance is $971. And that she has to pay it by May 3rd. So she has about a month to pay it. The minimum payment is $15. Again, if you pay the minimum, then you won't have any late fees. That could be like $30 to $50. However, it's a $35 late fee here. However, if you're only paying the minimum and you keep purchasing things, your credit card debt will keep growing and growing. You'll keep paying interest on your account. As it shows here, her credit limit is $3,000, so she can't spend more than $3,000 on this credit card. It tells you the billing cycle. It tells you the different things that have occurred in her summary, her activity. So again, she has finance charges of $43, so that's her interest. Okay, let's skip down to purchases. So you can see her purchase. So again, you can see what you're purchasing throughout. If one looks confusing or you didn't pay there, so for example, if you didn't go to great online movies, you can dispute it or talk to your credit card company. But let's say she did pay all these, and again, the current amount is, or the amount shown here is $278. Her variable is 15%, her interest, and that's the annual percentage. She doesn't pay an annual fee. So again, she can pay $15, but to be financially responsible, fiscally responsible, would be to pay off her credit card payment as well, if possible. But at least pay the minimum. Next, we'll look at housing. So the most expensive purchase that you can make is housing. Okay? So we're going to look at the options of rent or home ownership. So usually, if you plan on staying somewhere temporarily, you want to rent. If you see it as a long-term stay, like staying in Falls Church City for more than 3-5 years, then probably owning may be a better thing if you can do it. So renting. With renting, you'll have little or no upkeep costs, meaning if something breaks down, the landlord has to pay for it. Rent payments, again, it's the same for owning a home, should be no more than 25 to 30% of your net income. So if you make let's make $5,000 in a month, your net income, you should only be paying something like $1,200 in rent, ideally. That's why some people consider getting a roommate, or, obviously if they have a spouse. The amount of rent you'll pay is determined where you live. So in Falls Church City, the rent may be higher than in Prince William County, for example. And then often when you rent for the first time, when you sign the lease, there's an application fee. There may be a security deposit, meaning you have to put money down. You get that money back once you leave, as long as the place is still nice. and sometimes you have to put down the first month's rent. As we said before, some people also have renter's insurance. Okay, when you do sign for that, it's a legal document, as we've mentioned before, and it's a contract between the landlord or the company and the tenant. The tenant is you, who's occupying the place. So it's important to hold on to your lease agreement and to make sure you fully understand it. Now that's renting. Another option is owning. You can own a condo, a townhome, or a house. A condo is like the Byron, for example. It's where it's a building, and it sort of is like an apartment, but people own those different, the housing, the condos, for example, instead of apartments. A townhome is like Winter Hill, where there are houses put together, and then single-family homes. Again, you can go down, for example, any major street like West Street and see a bunch of single-family homes. A home, as I said before, is the biggest purchase you'll ever make. Consider staying there at least 5 years. Before making a purchase on a home, you need to think about, do you have a steady job? Do you have cash down or a down payment? Usually it's preferred 20%. Sometimes you need as little as 3% down. Consider your current debt, your other expenses before buying. Also, mortgage payments should be no more than 25 to 30%, just like in renting. Now with homeowning, you also have a real estate agent often, and you also have to select a lender, meaning someone you're going to borrow from, what bank. So it's important to talk to multiple people and to see what interest rates they can provide you and try to get the lowest possible rate with someone that you trust. Once you qualify for a loan, mortgage costs will depend on your credit history. Costs may include rate points or fees. So for example, you can get a lower rate by paying something called, by getting points, which is like credit, towards a lower interest rate. Again, important to compare rates and review lenders. And then you'll need homeowner's insurance, which will be a couple hundreds of dollars, depending on the cost of your house, and whether it's a condo or a house. And then typically a conventional mortgage is equal payments paid, and usually the typical is a 15, 20, or 30-year fixed interest rates. So in 30 years, you will own that house outright in a 30-year mortgage. You'll still have to pay taxes on it, of course, but you won't have to pay a mortgage on it. All right, the next concept we're going to look at is cars. So there's something called leasing a car, which is like renting a car, or buying a car. There's advantages and disadvantages to all of those. So we're going to look at leasing first. Leasing is usually a lower payment per month than it would be if you're buying a car. So leasing, for example, I'm going to show you an example. Let's look at Hondas, for example. If you have the Civic hatchback, it's $179 for 36 months, which is 3 years. So every month you pay $179. Now, before you can get this car, though, to lease it, you need to sign and pay about $2,600 up front. And then in 3 years, you need to return it. And this would occur for different cars as well. So for example, if you want a more expensive car, like an Accord Hybrid CVT, it's $239 and it's $2,700 up front at signing. So there's different options just to be aware of. Okay? Sometimes you can negotiate a down payment on a lease for a little less. Typically you pay less taxes with a lease. And also the nice thing, some people really find this as an advantage, is that you can trade in the car every 2 to 3 years and get a new one. So you can get the 2017 Honda Accord or Honda CR-V, and then in 3 years you can turn it in and get a new one, a 2020 Honda Civic or Honda Accord. And then maintenance, since they are newer, you tend to have less long-term major maintenance that you need on the car. So that's leasing. Now buying a car, the advantages are, once you pay the car, it's yours. So once you purchase a car, let's say it's $20,000, once you pay it off, usually the monthly payments are 3 to 5 years. Once you pay that, you have the car and you can keep it however long you want, or you can sell it to someone and get money back. A rough rider. If you're a new driver and you bump or scratch or have minor dings on the car, this is yours. So again, you can decide what you want to do with it. If that happens when you're leasing, you'll pay for that. Once you buy a car, it's yours. Again, with leasing, you're limited to X amount of miles per year, so either 12,000 or 15,000 a year. If it's your own car, you can put 20,000 miles on the car, or 2,000. It's up to you. And then generally, insurance is cheaper over time buying a car compared to leasing. And then also long-term costs. Owning a car will probably cost less than leasing if you own it for several years. All right, the last concept is identity theft. So what we're going to have you do is we're going to have you read through this sheet, but again, some just really basic things. When you're talking to someone over the phone or in person, you should never share your social security number, which you'll probably learn in high school if you don't know it already. Be careful about sharing financial information on social networks or anywhere else. Also, don't share credit card numbers or bank accounts with other people. Use strong passwords. Shred any documents with personal or financial information. And then you should also check your credit reports at least once a year when you turn 18. Some other ideas. Open your monthly statements promptly and check to make sure you see any suspicious activity. Cut up old cards that you don't use. Don't carry your PIN number when you have a debit card, because then someone could access it. And also check your statements again, your transactions, to look for any fraudulent behavior. Now, we've thrown a lot at you. What we want you to do now is we want you to think about your future goals. So think about it through three lenses here. What's your future goal while in high school? Now we're talking about financial goals. After high school, okay, so immediately after high school, and then sort of becoming like a full-fledged, exciting adult, let's say 22, between 25. So looking at the next 10 years, sort of what are some financial goals or future goals you have? So maybe it's after high school, maybe getting a car, for example, your own car. Or maybe it's renting a place in college or working in the city and renting a place. Maybe being an adult, maybe paying off your college debt or paying off debt that you have. Maybe it's exciting, like saving money for a cool trip or saving money for a down payment of a car or a house. So just have fun with this with some future goals that you may have.